Good afternoon, everyone. I hope,
Pleasant afternoon.
hey, okay, thanks for speaking up. Hey,
Good
so you
afternoon.
could clearly hear me. You helped me to test just now. Okay, good. So I see we have five persons on the line. Well, four. We have quite a bit of persons who should be in this class tonight. So let us give them until 6:05. All right, good afternoon again, everybody. So it's 6:05, we can get started. So thank you so much for joining our first session of the Credit and Collections course. I am Andia Delancey, and I'm excited that you took on the opportunity of taking up this particular course. I will be your lecturer for this course. I also do the second one to this. I see I have some of my students in this class, so it's good to see you guys again. And also, I encourage you to go straight through to the other one. There is a course two for credit and collection. So I encourage you to consider doing that after you complete this. So just to tell you a little bit about who's going to be teaching you this particular course. So I have been in banking for quite a long time, over 20 years. So Actually, I've been in retail banking most of the time. But also I have some experience straight across the board in collections, insurances. But the bulk of my career has been in sales. So I've been teaching at BIFS, I think maybe about 2, 3 years now. I have to look at the dates. But I am employed at a financial institution where I'm the senior manager of what we call a sales center. So pretty knowledgeable about the course that I am going to be teaching you. And so the objective of this course is for you to really get a better understanding of the importance of credit and how quality credit actually impacts collections as well. And I just want for you to get more knowledge on that, to be able to take it back to your workplace and just to help you to continue to build on your knowledge in that area. So I want to actually get to know some of you a bit more. And if you could just open up your mic, no particular order, but I see where you're from. But if you're okay with just telling us a little bit about yourself, I'll call on you, Damien, because you were the first person to tell me hello when I came on the line.
Pleasant evening, sorry. How you doing?
I'm well. How are you?
Wonderful. Thank you. Good night, everybody. I'm Damien Maycock, employed at National Workers Cooperative Credit Union. I've been here for 4 years. This Christmas made 4 years, I think. Yeah, it's 4 years. I was previously in banking at BOB. I did 10 years at BOB in San Salvador, and
Okay.
I moved, transitioned this way. I left the bank and was in the hotel, and left there, and I transitioned back to Nassau. So I'm here, and I started at NWCCU.
Okay. All right. Welcome. It's nice to have you in this class.
Thank you kindly. A pleasure.
Okay. All right. So let me call some names. Karen.
Hello, good evening, everyone. My name is Karen, like she said. I am also at National Workers Cooperative Credit Union. I just recently went there. It's only been 6 months. Before there, I was actually a teacher, so this is all new for me and happy to gain knowledge.
Oh, that's a big jump from teaching straight to where you're at now. So wishing you all the best. And I hope that you find this class to be beneficial and I'm not too boring for you.
Mhm.
But I hope that you're going to learn a lot from it.
Thank you.
All right. Janae?
Good evening, everyone. My name is Janae Gibson. I am currently at Cisco, which is a wholesale company. I'm in their accounts department, but I also came from Bank of the Bahamas, and also I was in the private banking sector under an offshore bank known as Winterbottom. So banking isn't something new to me, but I currently have a bachelor's degree in accounts, but I honestly love my banking job and I wanted to get another certification, so I'm thinking on going back into the banking sector because I loved it, but I also love accounts as well.
Okay. So you're in
And I
accounts
just,
at Cisco?
yes, I just started there last year, September.
Okay. All right. Okay. Welcome. Good to have you. And I can hear from in your voice you have a passion for banking. So I hope you find your way back there. Okay. Who else? Tashelle?
Good evening. My name is Tashelle Grant. I am currently with the Bahamas Law Enforcement Credit Union. I've been there for about 4 years. February 1st will make me 4 years. I'm not new to the banking field. However, I worked with Fidelity um, for about a year and a half, a little while ago. This was like 2018 to 2020. I think then the pandemic hit. I ended up having a daughter, and now I'm back. So I've been with them for 4 years, like I've said. I'm actually in the Freeport office, where it's actually just only two employees. So we do a little bit of everything. And yeah, so I'm here to learn more, um, just to broaden my knowledge or widen my knowledge, I should say.
Okay. All right. Welcome. Okay, Mariah. Okay, we could come back. Did I miss anybody? Okay, no. Oh, Mariah, you ready?
Yeah,
Okay.
I just logged on.
Okay.
What's the question?
So we were just doing an introduction. Just basically tell us a little bit about yourself. I went, everybody else went, so you're the last to go.
Okay, my name is Mariah. I currently work at BPL. The reason why I would like to do this course is to just have an idea about credit and collections
Mhm.
for dealing with billing, and it's a part of our system for reconnections.
Okay. All right. So with this particular course, thank you for that, Mariah. So with this particular course, I'm going to try to tweak it a bit to fit you as well, because when you look at the module, you'll see a lot of it. Two is encompassing credit from the financial services aspect. So I wanted to know where you work so I could kind of put some of that in there as well. All right. Okay, so thank you for that. And I don't think we missed anybody else. So I just wanted to share some key information with you. So this course is going to be for 8 weeks, and the midterm is going to be on February 11th. So when we do the midterm, that will be like the halfway point, and it will only be, of course, on what we've already completed or what we've already reviewed. So February 11th. And you will have the final exam on March 21st. Okay, so that's a Saturday. So our last class essentially is going to be on March 11th. And after we finish that, then we have a week break, and then you would have your final exam that following Saturday. Well, the week after,
Sorry, what was the date for the final exam?
March 21st.
Oh, 21st, 31st. Thank you. Sorry.
Yeah. That's a Saturday, and you'll have it at Biff's. Now, I heard a couple persons don't live in Nassau, so you can reach out to Miss Dean, and she could arrange that for you, to do it virtually. All right. So just to let you know how I basically grade this course. So you can easily get 10% if you participate. Easily. And what do I mean by participating? So virtual sessions, um, there's only so much you could do with virtual sessions, but for me, engagement is very important. So, like, participating in answering the questions, asking a question if you're not too clear. And no question is a dumb question. Even if you would like to reach out to me after class and ask me a question, that's particularly fine. I don't have an issue with that. So I will drop my contact in the chat group, and you can feel free to reach out if you have any questions. So participation is an easy 10%. Your midterm has a 30% weight, and the final exam has a 60% weight. Okay? Any questions on that? All right. Okay, I saw we had a couple more persons join
So,
us. So,
I'm so sorry. You said the final exam is the 60% weight, you said?
yes.
It's just participation 10%.
Mm-hmm.
And that was it.
And midterm 30.
Midterm. Oh, obviously 30%. Okay, thank you.
Okay, no problem. All right. Jabber, am I pronouncing it correctly? Jabber?
Close is Javale.
Javert. Okay, sorry,
Yes,
Javert. Okay, so Javert, we were just giving introductions in terms of what do we do, like where we're at. So can you tell us a little bit about yourself?
my name is Javale. I'm I'm working at Commonwealth Bank. I've been there for a year and 9 months. I'm currently a teller, but I'm trying to secretly work my way up the loan. So when opportunity come, I can just go straight there.
Okay. All right. So you said a year and how much months?
A year and 9 months.
A year and 9 months. Okay. All right. Okay. Well, welcome. And I hope that you find this class to be helpful to you as you navigate your journey into the loans. All right. So
Thank you.
let's start with going through a couple things. So this week we're going to really go through the foundation of exactly what credit is. And credit is just an arrangement for you to get something now and basically pay for it later, right? That's a simple definition of it. You can use credits to basically pay for almost anything. But in order for you to qualify for credit, you have to make sure that, you meet the rules of whatever that particular institution may be in terms of their credit policy rules, etc. So I want to kind of go through when we think of the word credit, right? Can anybody tell me right now we have an agency that could basically provide us with a reporting of how a client's credit is. Anybody could give me the name of that agency?
Credit Bureau.
Okay, yes, the Credit Bureau. So in the past, we would not have had a credit bureau before. And so the transparency of a client's overall credit worthiness was not really available. And in the past, financial institutions really relied on the declarations of clients to indicate, what their overall their credit history was like. And so like if you said you had a loan to Bank A, in the past, they would have asked you to provide a reference, statements, etc. But now, with the presence of the credit bureau, the client signs a consent form giving the institution approval to be able to access, their credit history, which is really, really important. So, in the aspect of the banking world, we would go ahead and issue two kinds of credit. One is secured credit, and the other one is unsecured credit. So, let's delve a bit deeper in there. So, when we think of secured credit, right, can anybody tell me what is a type of product that a bank will facilitate that is considered a secured credit?
Homes.
What's it?
Homes like mortgages, like
Yes.
okay.
You got it. So a mortgage is a type of a secured credit. And what would the bank be holding? Why would we consider that secured?
They
It
hold in
could
the
be
home as collateral.
Correct. So you're either holding the home as collateral, the real estate, whatever it is. And sometimes it could be a vacant lot, right? So mortgages are considered secured credit. You will really never find a mortgage unsecured. It will always be secured by something. So what about auto loans? Does the bank do unsecured and secured auto loans? So let's say I
No,
want to
ma'am.
purchase. Sorry, go ahead, Damien. Or
No,
or
I was about to say no, I don't. We don't.
yeah. Yeah,
That,
so
that,
it depends. So if a client comes in to purchase, let's say to purchase a new vehicle, we know that the bank would be holding the vehicle as security. But let's say the client comes in and they want to purchase a vehicle that costs $8,000. Is there an option to do that as an unsecured loan also?
Yes, ma'am.
Yes. Yes, absolutely. So it depends on the client's ability to actually qualify for the credit and also the purpose of the loan. So if a client walks into the bank and they say they want a new auto loan, um, more than likely the bank is going to hold the auto loan as security, right? You may have some instances though where the security type can be changed. And it depends on the overall client's financial profile. Like I have seen instances where a client may want to purchase an auto loan, but they don't want the bank, I mean, they want to purchase an auto, but they don't want the bank to hold the vehicle. And so they would go ahead and put up cash, etc. So it just depends on how that particular credit application is presented. So, what is another type of secured credit that banks would facilitate? So, we have mortgages, we have auto loans. Any other ones?
Cash secured.
Yes, absolutely. So, cash secured. All right. So, let's move on to unsecured credit. So, since we know what secured credit is, which is a type of credit facility that is secured by collateral or lien, then obviously an unsecured credit is something that is not. What type of products do banks consider as unsecured credit?
Any consumer?
Yes, consumer loans.
Cards? Credit cards?
You said credit cards, right?
Yes, ma'am.
Okay, yes, credit cards. Yes. All right. So we have a good understanding of what an unsecured credit is and what a secured credit is. So let's talk a little bit about how terms can be different based on what type of credit it is. So, with a mortgage, mortgages typically tend to go very long in terms of how long the client has to repay it, and customary because those balances are much higher. And so, in some cases, clients can have up to 25 to 30 years to repay a mortgage. It just depends on which bank is facilitating the transaction. Auto loans, they do have a long, well, when I say long, it's a bit longer than a regular consumer loan because the bank is holding collateral. So you may find in some instances where banks can go up to 8, 9 years. I've even seen some banks go up to 10 years. So based on the product that the client is getting and the type of collateral that the bank is holding, you will find that they will have an appetite to give a longer term on the facility because it is secured by some type of collateral. Cash secured loans, they don't have that long of a term. Those terms, I guess they could vary. It depends on the bank, but the terms are not that long on those. And so just to give you an idea, you're probably looking at 5, 6, 7, 8 years. Now, when it comes to unsecured credit with consumer loans, you will find that those terms are much lower than it would be on something that is secured by credit. And why do you think that is the case? Anybody?
Sorry, could you repeat that?
Unsecured credit. So, for example, a consumer loan that is unsecured. Why do you think the bank would give you a lower term on that, a lower term for repayment?
Because it can be salary deducted.
Salary deducted. Okay, go a little bit more. Think about, so it's unsecured, right? Um, when it's unsecured, do you think the loan is a bit more riskier?
Yeah.
Yes,
The
ma'am.
risk is higher.
Yeah, so right there. So because the risk is higher, then the term is not going to be as long. And so banks take that into consideration as well. All right. So in banking, we also have facilities that we call revolving credit. And Damien, I think you gave the product type for that, and that's considered like credit cards. And so credit cards are considered those facilities that have revolving credit. So for example, let's say if you have a credit card of $5,000, a credit card with a limit of $5,000, it doesn't have an expiration date on it. It's you just continue to use the card, pay it down, use it, etc. So even though credit cards don't have expiration dates on it, banks do look at your ability to repay your credit cards on time. And if they observe that on the credit card, there may be like missed payments, delinquency, etc., sometimes they can pull back the limit so that you don't have access to the credit. And so, that impacts your credit history. So that is an example of a revolving credit. There's also another type of revolving credit, and that is called what we call, like, you may find that some institutions have what we call lines of credit. And in some cases, those lines of credit, they can be secured or unsecured. depending on the balance of the facility and the overall risk of the client's financial profile. Any questions so far? Okay. So the main benefit of a line of credit is really flexibility. So because it's revolving credit, let's say if you use up the entire $5,000, it doesn't say you pay the $5,000 back the same month. Now, it probably is best you try to pay it back, because if you pay it back before the statement drops, then you actually save on the interest, right? So with credit cards, same thing. Even though a credit card only requires a minimum payment every month. Not that it only requires it, but the consumer is only required to pay a minimum payment. If you want to really manage your credit well, you want to ensure that you're not carrying high balances, and that way it allows you to also have an advantage over the high interest payments. Okay, so with a line of credit, a person can borrow as much or as little of the available credit as needed. And essentially, what that means is if you have a limit of $5,000 and you don't need it, you don't have to draw down the full 5,000. And when I say draw down, you don't have to use the full 5,000. You can just use on the amount that you require. And so line of credits are really attractive products. So let's say if a client qualifies for a $50,000 line of credit, maybe the client doesn't know when they will need it, but the bank has provided them with that particular flexible product so that when they need it, they have access to it without having to go through a formal application process. So I'll pause now. To just find out, based on what we've spoken about so far, the secured and unsecured credits. Um, is everybody clear on that, or any questions?
I think so far so good.
Okay.
Same here.
Okay. All right, good. Let's see something. Hold on one second. So credit cards are the most common forms of a credit line. And as we mentioned earlier, the maximum amount of funds available to a credit card holder is known as the credit limit. So cardholders can borrow up to their credit limit. They can repay the funds borrowed and then borrow the amount again. All it means is revolving credit. So another common line of credit is what we call a home equity line of credit. You would find that that is usually in the United States. So in the Bahamas, we would simply call it a line of credit. Not all institutions offer that particular product, but that is an option where it is available, where you can get a secured line of credit against the equity that you may have in your home. So I've seen instances where people would use facilities such as that to pay for education, do renovations to their home, etc. So as they need the funds, then they would just access it from the line of credit. Okay. So let's go into looking at what is a credit score. So I'm not sure if everybody has seen the CRIF report, but the CRIF report actually has a credit rating on it for clients. I think it goes from A to, I can't remember the number, not the number, the letter, but with A being the best. But albeit that, what actually happens is banks have their own internal risk rating. So what that essentially means is you may find that when you collect data on a client and you key an application for that particular client, it generates a risk scoring rating for that client. I'm not sure if that's the case straight across the board, but in some cases, banks do their own analysis to determine what the client's credit score may be. So credit scores are based on a variety of personal financial data, but let's just imagine a CRIF report for those who have seen it before. Can you share some of the things that a CRIF report would highlight on it?
The balance of the loan, the payments.
Mm-hmm.
I mean, as far as detailing all the personal information, though, or you mean really
No, you got it. So personal information.
to identify the person, tell where they live and stuff. I remember the score,
Yeah.
the credit score is usually there.
Does it
Well,
show
all the credit
history?
cards, sorry, all the loans you had from the different financial institutions, but they don't tell you which institution it is. They have them numbered or something.
Correct. Yes, they have it numbered. So
Yeah.
remember, well, everybody may know this, but the one that the bank pulls will always have a number, but
Ah,
the one that the client gets directly from CRIF will say who the bank is.
oh,
Hmm. Okay. So clients are entitled to get one free credit bureau report every year. All right. Okay. So it gives you the balance, the payments, the personal information, the scores. It also gives you credit history on the facilities that they've had. Anybody else want to add anything we missed out? What about if the client has previously applied for any other facilities? Even if they didn't get it, does it show if the client is applying?
yeah, I think it shows the record as of that as well.
Yeah, yeah, it does.
Hmm.
Okay. And it also shows open facilities as well as terminated facilities. Um, the credit bureau report, does it show what about credit from other institutions such as utility services providers?
I think I've seen one with a phone,
Mm-hmm.
but I didn't understand what it was actually. But I think
Yeah.
I've seen it with the phone, a phone, something with the phone.
Yeah, so they actually started reporting the phone bills on it, and it's expected to go in phases where, other institutions will be able to report on it outside of banks. Okay. All right. Anybody else wanted to add to what Damien shared so far?
I have a question. Does it also have the person's employment history as well?
Yes.
Okay.
It has their employment history, their annual salary. And I think Damien shared earlier the personal information. So like the NIB number to confirm that it is the person you pulling up, etc. I think
I
it,
think days you miss payments and stuff too, delinquency and stuff.
yeah, the credit history definitely.
That is the credit history, yeah.
Yeah. Okay. All right. So with the presence of the CRIF right now, it actually saves clients a lot of time because back in the past, remember, clients had to go and gather documents. That no longer applies. The only way they would have to gather a document now is sometimes we have seen when pulling the CRIF reports, there may be some inaccurate information. And so clients would, and I say inaccurate, just to address that, inaccurate because it may still be showing up as active, the facility, and the client says no, it was paid off. And so in instances like that, we would ask the client to just get confirmation from that bank confirming that the credit facility is closed.
Question.
Do they also
Oh,
have where you are taking the court for, say like you didn't repay a loan or, like stuff like that?
Yeah, they have they have what we call bad debt or charge off facilities on there. But I don't think so let's say if the debt gets transferred to a collection agency, so far, I have not seen where the collection agencies are reporting on it. Did that answer your question, Mariah?
Yeah, I was trying to ask for someone.
Oh, he's asking for someone. Okay,
Yeah,
yeah.
my cousin, she work in a bank. She say, they're gonna have it where if the like say a collection agency takes you to court,
Mm-hmm.
yeah, they say it may have that as well.
Okay, so I guess that's coming because they were doing different phases with who was reporting. So I don't see why not, because we have quite a bit of collection agencies in the Bahamas. And so even though you may have instances where a bank actually um sells let's say if they sell the balance, the portfolio to a collection agency, we have seen where it's still showing up under the bank, and when you reach out to them, they may say, well, hey, this was sold to this agency. And so you would have to reach out to them to see if the customer would have settled it directly and get evidence in order to say that the client has addressed it. All right. Okay. Damien, I think you wanted to add something.
Oh, I was going sometime like you said do so it's because they just didn't update it yet or something you said. Is why
Yeah.
they did all right. Because that was the difficult trying to figure out why persons were saying the same thing, like you say they paid off the loan, but the the credit score of the CRIF was saying something different otherwise. But you say it just because it wasn't updated yet.
Yeah, it wasn't updated. So I don't know why there's a delay in terms of updating it because, like how it identifies each institution by a number based on the report that we pull.
Mm,
Like you would see, let's say Bank One, let's say Bank Two, because Bank One will always be the person who's pulling the report, the institution who's pulling the report. But let's say Bank Two, you may see 5 years ago the client had a balance of 20,000. And last year, the client got another loan for 30,000. Same bank, but you've seen where the payments were stopped. The payments stopped reflecting for the other facility, but it's still showing as active, right? So based on that, you could see like where the client probably did a top up, etc. But in most cases, because that information is reported on the CRIF as it is, in order for a bank to say they would have exercised a sound decision in terms of approving a client or not, they would normally ask for the client to get something from the bank just to confirm that it's only one facility or no facilities, etc.
okay, I understand that.
Okay, so in the Bahamas, we know our credit bureau is CRIF. In the US, they have a couple different agencies. You may see TransUnion, Experian, or Equifax. And those US credit reports look quite different from ours. So in my role, I work with a lot of non-residents as well. Like we do financing for non-residents and residents. And so it's capturing similar information, but the report does look different from the ones that we have locally. Okay, so we talked a little bit about what is a credit bureau, and we know who the credit bureau is in the Bahamas. That's a question that will come up on your exam. And we also talked about some of the information that may populate on the credit bureau report once you pull it. That is a question that you will see again. All right. So it says here, type of information, repayment history, amount of credit available, length of the credit history, types of credit accounts, number of credit inquiries. What is that? Tell me, what does that mean when it says number of credit inquiries?
How many times you inquired about your credits?
Correct. And in the USA, or even here, when you have a high number of credit inquiries, what does that do? Anybody could tell me what they think that does to the score, to the client score?
It lowers it.
Yeah, it does. And why do you think it would lower it? Take a guess. Don't have to be right, but I want you to try.
Okay, in my head, I
Mm.
think in terms of the client basically switching jobs and stuff like that would be one of the reasons why they keep inquiring about their credit score
Okay.
to get a different because each job, which means your salary switches, just means your actual worth of what you could borrow would change. And
Not exactly, but I thank you for trying, Janae.
Okay, I was trying.
Okay, thank you.
I was
Anybody
actually
else?
I was actually sort of agreeing with her too, but I was saying with the where she said actually that it's actually changing like not only jobs but institutions, like you from institution to institution getting loan here, loan that, probably consolidating and getting another one. Yeah, and there, maybe.
Yeah, so your second part, right?
Okay.
Yeah. So like if you continue to borrow, like let's say like a lot of times you may find like the bank may think it looks a bit risky because you consistently applying for credit in a short period of time. Now that isn't the same like once a year, etc., etc. It depends, right? But they do look at the number of credit inquiries. And sometimes you may have a client who can't get something at this bank, and so because they can't get it, they go to another bank and then they go to another bank. So it could send a signal, not to say that a bank makes a decision based on that, but it's a good to know information. All right. So I want for you to pay attention to the data collected because that will come up again. We also spoke about the credit bureau actually having information too on the client's address, their employment history, and also their salary history that comes up on now. So, banks, credit card companies, and other lenders use the information gathered from credit bureaus to determine the credit worthiness of their customers and to decide which products to offer them. For example, a credit card company may offer a balance transfer credit card to someone who carries high credit card balances. All right. So I indicated earlier too, borrowers are entitled to view their credit reports at least once a year free of charge. So if you wanted to find out more information on that or how they go about doing that, you could actually go on CRIF website and it reveals, what's the process to get that done. All right. Any questions so far? We could keep it moving. All right, so I want for us to talk about credit history. So, a credit history is basically how you repay your facilities. You could come in a bank or you could go to any institution that offers credit and you could say, oh, I pay my bills really well. Every month I pay on time. But what the credit bureau report does is it actually just verifies that information for us. So a credit history is really the record of how a person has managed his or her credit in the past, including their total debt load, timeliness of payments, the number of credit facilities that they have. So lenders look at a potential client's credit history to decide whether or not to offer a new line of credit and to help set the terms of the loan. So in some instances, you may even have employers and landlords who can ask you for credit histories to determine if this person is a suitable job candidate or if they may be a good tenant. So let's stick a pin there with credit. Well, I know some of you everybody, this is your first time doing one. Why do you think credit history is important to anybody who's in the business of lending money?
Because they want to make sure they're able to pay the loan.
Yes, they want to make sure they're able to pay. Yes. And one of the best ways to determine if a client will likely pay you in the future is what?
To check their history.
Yes. So, and if we sum it up in one word, that's what we call 5 C's of credit. What particular C of credit does this fall under? So there's 5 C's of credit. And I'm not sure if anybody did that as yet. So
But the
character,
for fall under
Alexis?
risky.
character, character. So there's 5 C's of credit. We'll go through it a bit. We'll go through it a bit later. But there's 5 C's of what we call credit. So in the world of credit, institutions really look at what we call the 5 C's of credit, right? And one of the most important components is character. And what character simply means is character is what you say you're going to do, you're going to do. So it actually assesses the overall credit worthiness of the client. So how have you paid previous loans before or previous credit cards, etc. Even if things went bad for the client, let's say if the client lost their job, right? How do you think a bank can look at a client's character even when they have difficult times with paying? How do you think they would look at it? This is almost like a collections question now.
Check out their previous history.
So check out their previous history, but what about their promise to pay commitments?
I mean, like signing a promissory note.
No, so let's say if you have a client who goes delinquent, they lost their job and they're delinquent, and you as the collections agent, you call to find out when are they going to make their payment. And the client tells you, well, Mr. Maycock, I just got a job. I am making XYZ. My income has changed, but I could commit to paying you next week, Friday, this amount. So when next week, Friday come, you actually see that the client has made the payment, right? Um, that type of response from the client also allows you to see their character in difficult times because people's situation could change. But even when it does, even in the world of collections, the client can reveal their character to you even in instances like those.
Where they're making at least an effort to pay something.
Correct. Or even communicating to you because the client might still not be working, right? But not willfully ignoring you. You send in communications to the clients and they're not answering. They got the same number, or they may add you to the block list, right? So even in the collections world, banks would have what they call customer relationship management systems, where they actually keep a track of the collection notes when they are dealing with any delinquent accounts. And so let me tell you how that is very important. So recall I said earlier that people's situation can change. All of us on this call, our situation could change, right? And what could happen is, let's say you're not working and your facilities go delinquent, and a couple months later you get a job. You start to work and you never pay the debt that you had before because you say, you know what, man, I so far behind, let me just keep it moving, right? And call I want a note. What could happen is when you go back to the bank for future credit, they will look at how you would have they would look at how you would have communicated to the bank with regards to addressing your debt, right? So in some instances, I can tell you where clients come for new credit, and because they would have not handled it like they should have, it prevents them from getting new credit. And like for sometimes it's even small balances, right? And the customer will be like, well, I'm making all of this, my income has significantly changed. It's only a couple dollars. I could pay it now. But the bank is really their thing is they're really concerned about your character that you would have displayed at that particular time. Is it that you're only going to settle the debt now because you want something from us? Or, they need to understand because remember, at the end of the day, this is your money as a depositor that they are taking and lending out in the form of a loan. And so they need to make sure that if anything comes under scrutiny, they can easily say, we would have made a sound credit decision by advancing new credit to this client. So it's very important that even in difficult times for um, clients to even stay close to institutions that they may owe funds to, and just be honest with them. Let them know if you don't have it, I don't have it now, but I'm going to keep you updated in terms of when my situation changes. And when your situation changes and you have the ability to repay, then contact your institution to make sure that you put payment arrangements in place so that the facility can be called what we call rehabilitated. So I've seen instances where because a client would have done all those things, during the moments when they had a difficult time, when it came time to get new credit, the collection notes showed exactly how the client would have kept their commitments to pay. And we were able to use that to justify that, what happened to create the delinquency was no cause of the client. The client stayed in contact with the bank, etc. They have now rehabilitated the debt, and we feel as though there's sufficient rationale to be able to advance new credit to them. So I know that was a lot, but any questions on that? Okay. So essentially, a good credit history makes it easier for you to obtain credit. While if you have a bad credit history, it can prevent you from borrowing or significantly reduce your options. If you have a history of not paying bills on time, or if you have filed for bankruptcy or had accounts go into collections, you may have more trouble doing everything from finding a place to live to getting a job. All right. So, Mariah, I know you're from BPL, so just to kind of show how this could apply in your space. So for clients who have delinquent accounts, let's say if they want to get their lights turned on at another location, how does delinquency impact, I guess, the terms and conditions for any new requests that they may ask?
Well, with that, we would open up a new account, but we transfer the balance from the old account to the new account, and then we turn your lights back off
No, but it
until
ain't
you
on
could pay.
yet.
Oh,
I
it
mean,
isn't on yet? Well, no, we don't allow you to open up a new account unless you at least pay half of the old balance.
okay, and then the other half you'll transfer to the
And
new account.
yeah.
Okay. Okay.
Mm.
So does repayment history, let's say if you have a client who repays their billing cycles really well, does repayment history impact the deposit down payment for any future services?
No.
Okay. All
Yeah.
right. So you have a standard like fee in place.
Yeah. But when we put you into the new place, we try to go up on the deposit amount, saying like if you're bad pay. Yeah.
Okay. All right. Thanks for that. Okay. So I think that's a good understanding of credit history. It just simply means how you repay is going to determine, if an institution wants to take an opportunity and advance you new credit. So it's very important to ensure that you repay your facilities on time. I know some people may even say, well, I pay every month. Every month is not the same thing as on time. So I've seen like on some credit bureau reports, you could see like the client paying, but like they like between that 1 to 30 day cycle. So even when you get credit from anywhere, always make sure that you're aware of what the payment date is. Sometimes you may hear a client say, oh, well, I could pay the late fee, right? But the late fee is like ain't even really the thing to be concerned about. Anybody could tell me what is the real thing to be concerned about is two key things. Take a guess.
Just
Interest. The
mhm.
interest. Mm-hmm. Let's stick a pin now. So let's say if you have a mortgage of $180,000, right? And let's say your mortgage is due on the first of every month. Your payment is due on the first of every month. And the bank charges you a late fee starting on the third day. Um, the third day after the payment is due if you don't pay. So late fees get assessed by the third day. So let's say the late fee is $50. So you get your $50 assessed, and let's say you don't pay until the 10th. So that means for about 9 days, you would not have paid because you didn't pay on the first. And out of those 9 days, we need to look at what your daily interest is. So let's say on a $180,000 mortgage, your daily interest is let's say 40 something dollars. Let's say $40. The excess interest that you would have paid to the bank, you take that $40 and you times that by 9. How much is that? How much in total would the client have paid? Anybody?
480.
Any? Sorry, I didn't hear you.
I was guessing 380.
360.
360. So 360 is just the interest cost, right? Because you wouldn't have paid on the due date. So 360, the interest cost, and then what else would the client have paid? What else we need to add to that 360?
Monthly
Late
payment.
fee.
The late fee, absolutely.
Oh,
So the 360 plus the 50 would have cost you 410. Sorry, go ahead, Damon.
I'm sorry, I just added in my head and speaking out loud. My apologies.
Yeah. So by you being 9 days late, you might think saying, well, they getting it this month, but 9 days late costing you $410 extra. All right. So you always want to make sure that you understand what your due date is on any facility, and you as you students on the line as the professionals, that's an important part of the closing process with the client. So make sure that the client is clear on what their due date is so that two things, they can make sure they protect their credit history, and also they're not paying any additional interest or fees. So let's look at this credit history example. So we have a client here, Antonio, who has 3 cards listed in his credit history, which details how long he's had each card, the spending limit on each card, and how much he owes. He also has a car loan and a mortgage, both of which are recorded in his credit history. With most of his funds tied up in his shipping business, Antonio has maxed out his credit cards in an ill-considered plan to help out a friend who has relationship problems. With the economy in recession, Antonio's business is in trouble. And his friend, well, he ain't have no money to pay him back. So all of this is just putting Antonio at risk of bankruptcy. And Antonio actually, the money he borrowed, so he's unable to pay back the money he borrowed via Antonio's credit cards, putting Antonio at risk of bankruptcy. Antonio would like to take out a loan to consolidate his debt, but when the potential lenders look at his credit history, they demand a painfully high rate of interest. So let's talk about everything that's what all did Antonio do wrong? Let's point that out. What was some of the mistakes he made?
Help a friend.
Help a friend.
Matt, I agree. I agree. Hey, and
But
what is the
why
rule
you
when you
got
helping a
three
friend?
credit cards though?
Child, that's the
I
norm these
think
days,
one was
Janae.
enough.
Yeah, but Janae, remember. So let's stick a pin now because credit cards have essentially changed now, right? The importance is you got to know how to use the credit card. So, for example, people are interested in rewards credit cards. So you may have someone who want a credit card for travel. It's a specific card for that. You may have a client who they ain't no traveler, but they do a lot of daily transactions, and so they're looking for cashback reward points. There's a different type of credit card for that, right? So let's just assume he has some very unique needs, and so he needs these 3 credit cards. But I want to tell you that is not unusual for someone to have 3 credit cards. But I heard y'all said, help a friend. So just a simple rule, and I know y'all already had this before. When you helping friends and family members, if you can do without it. Like really and truly, even though they say they borrowing, you have to mentally prepare yourself. Hey, it's a chance that they will not repay back. So just a golden rule to remember. If they pay back, it's all well. But if they don't, like that's a mindset you already have to have in place. Hey, there's a high possibility that I won't get this back. So if I can't do without it, then make sure you're making the right decision. All right. So first one was help a friend. But tell me, what are some more mistakes there? And also, Janae said having 3 credit cards. Okay, so we'll put that for this case.
I think he should have separated his business funds from his personal funds.
Yeah, absolutely. Separate the business funds from the personal funds. Okay. Anything else?
They shouldn't have exceeded the limits.
So he maxed out his credit cards. Yep.
Get in the next loan.
But he didn't even, oh, you mean in the end when he wanted to take out a loan?
Yeah.
Okay. Yeah, that could be one. But what is one we missing? A big one. So they said apparently Antonio used his credit card to give his friend this loan. Doing cash advances on credit cards are very costly. Very, very costly. So the cash advances is one thing, but credit cards carry a low interest rate or high interest rate.
High because of the risk.
Relatively high.
Yes, relatively high. So what he was giving his friend to help his friend out, he actually ended up paying more because he advanced the cash from his credit card, which already carries a high rate. And I think someone had mentioned earlier, he also went straight up to his limit. So he maxed the credit card straight out. So this just was something for disaster. And now he needs help. And so because he needs help, when the banks look at his credit history, why do you think they are asking him for why do you think they are offering him a high interest rate product?
To ensure that he'll be able to pay.
To ensure he'll be able to repay. Okay.
To ensure that you get something back because you see bad with it.
Because it said, okay, so to make sure you get something back. So all of you're trending in the right direction. But the words start with R, what I looking for? Why would you charge a high rate of interest based on the scenario?
High
This is
risk.
risky.
It's a high risk.
High risk. Yes, the client is high risk, right? So you want to charge a high rate of interest. So based on the information they have so far on the client, there's a possibility that he could encounter delinquency. And so the bank is charging a high rate of interest because if they do that, more than likely in the early terms of the facility, they would have already gotten back most of it, right? And his credit history also too doesn't help him out. So that credit history is actually another indicator to the bank that you can't give him a low interest rate. Like you should save that for your clients, your good clients. And so based on the evidence, in order for the bank to advance those funds, they are suggesting to him to do a high rate of interest. All right. So also too, someone had mentioned separating the business funds from his personal funds, correct? So if it is that he wanted to help his friend out, we can obviously see from here that he is self-employed. So using the money from his business account to help and it already says most of his funds were tied up in his business. So using those funds to help a friend out even further adversely impacted his business, which
Mhm.
which could impact his income. And so, even if he wanted to have a good heart and really help a friend out, he should have done it from his personal resources and not the business. All right. Okay, so good stuff, good scenario. So if it is that the financial institution decides to give Antonio the loan, unfortunately, he would have to accept it. If he really wants it, he would have to accept it at a high interest rate. And more than likely, they'll do a shorter term as well because he's considered high risk. So always remember, based on banks, it's all about risk. Is it a good risk? Is it a bad risk? And if it's a bad risk, then you have to make sure you price accordingly. If it's a good risk, then, the client could have options in terms of whatever it is that they're requesting from the bank. So we all want to be good risk, right? Sometimes things happen, but as best as possible, just make sure to stay in contact with the institution. Any questions so far? All right, so let's move to another one. So Clara opens her first credit card at 19 because she doesn't have a credit history and she would like to start building one. Because she's in school and she has little income, she is offered a credit card with a $500 credit limit, which is really typical for people in her situation. The credit line goes into effect immediately and she is able to start making purchases with the card. So at the end of her monthly billing cycle, she is made 246 in charges on the card, so she has to pay the 246 back. She could choose not to pay it or pay only a small amount, in which case her credit score will take a major hit and she will incur interest on the balance that would make it even more difficult for her to pay off in the next billing cycle. So Clara is a college student, right? What would your suggestion be to Clara? Considering this case scenario, like what are some things you'd start to say to Clara in order to help her in this situation?
For starters, only spend what you're able to put back.
Mm-hmm. So spend what you're able to put back.
Pay it
Thanks.
off.
Pay it off. Mm-hmm. So spend what you could put back, pay it off. Any others? Okay, so all of you are right. But as a loan officer, let's say if you were sitting down with Clara, it would be good to understand also like what's her goals. I know she's only in school now and it says she has little income, right? So even though the limit is $500, it's those credit cards where you tend to see people may not repay as they should, and it ends up following them in the future. So you want to explain to Clara exactly how important it is to make sure she can repay it. So even though she only has to pay the monthly payment, show her an example. So for example, let's say if she was using a debit card and she was going to make the charges on her debit card. In any event, the full funds were coming off. So even though she is using a credit card to make that purchase, give her counsel in terms of making sure she can pay back the balance. Because she's in school with little income, it makes no sense for her to accrue additional interest, and show her how she is saving by ensuring that she pays the balance before the statement date, etc. You could also go a next step up and try to understand what's her goal after school, right? And based on what she says, try to tie that in as well. And with educating her on how important it is to make sure that the credit card is satisfactorily repaid, because then it gives her the ability to easily access credit in the future. All right, so thanks for the feedback there. Both of those were good answers. So credit risk is essentially a measure of the creditworthiness of a borrower. In calculating credit risk, lenders are looking at the likelihood that they will recover all of their principal and interest when advancing the loan. Borrowers who are considered to be a low credit risk are charged lower interest rates, like we said earlier. Lenders, investors, and other counterparties consult rating agencies to assess the credit risk of doing business with companies. So, when determining the credit risk involved in making loans, lenders are judging the borrower's ability to pay back the debt. So, there's a number of factors that would go into assessing what the client's credit risk looks like. And this would include their credit history, which we can determine from the CRIF, and their credit score, debt to income ratio. Sometimes you might hear people say TDSR, and that just means total debt service ratio, and also collateral. All right. Any questions so far?
The debt service ratio, what is that?
So the debt service ratio is basically, it's just, so what we look at, every bank has limits in terms of how much you're able to actually spend towards debt or liability. So is a certain percentage of your income, right? So let's say you're dealing with a client who is making $30,000 a year. Financial institutions, based on their own specific credit policies, they may say, well, for loans, we're not willing to go over 35% in terms of your total debt servicing. So, what that essentially means is only 35% of your income could go towards servicing debt or liabilities. And so, in terms of placing it into a calculation so you could better understand, if you are dealing with a client who's making $30,000 a year, y'all could follow with me in the calculations. So you'll take the 30,000, divide that by 12. So the client's monthly disposable income. So disposable income means your total monthly. So their monthly disposable income would be $2,500. What the bank is essentially saying is, out of that $2,500, we are comfortable if you can go up to 35%. We are comfortable taking you up to 35% of that in terms of repaying debt. So you'll take that 2,500 times it by 35%, and only $875 would be able to go towards repaying any loans, credit cards, mortgages. So it's really a percentage of your income that's used towards paying debt.
Oh, okay. Okay.
Yeah. And that could change. So I say in 35% being conservative, but I've seen cases where it goes up to 50%.
Wow.
So when you put that in terms of numbers, right? Let's say you're dealing with someone who making 2,500. And that 2,500 is gross. That don't even include like NIB deductions, if you have medical insurance,
Mhm.
all of that. So if you taking this client up to 50% total debt service ratio, that means 1,250 of their income, we already say that go into debt. So essentially, they only have about $1,000 left to live off.
Wow.
Yeah, yeah. So even though a bank may have a certain guideline in terms of, hey, we willing to go up to 50%, you as the lender, you still have to take a holistic review of the client's profile and make sure you're putting the client in the right financial position.
Okay.
Okay. All right. Any other questions? Okay, so let's take a look. So we spoke a little bit about credit risk, why it's important. So let's look credit history and credit score. We don't need to go through that again. We already did that. Total debt load. This measures how much existing credit has been extended to a borrower and how much of the credit she has already utilized. The less credit a borrower has used, the more able they should be to pay back a new loan. Basically, what this is what I just talked about, the total debt service ratio. And remember, this could vary from bank to bank. So you also have the debt to income ratio, which is the same thing. They're just calling it a different thing, but this compares the amount a person makes against the living expenses and their debt payments. Lenders use it to decide if a borrower can afford to take on a new debt payment. You can have an instance where a client repays excellent on their credit facilities. The collateral is good. Um, the client's character is good, credit history is good, but if they don't have the capacity to repay, you can't do the proposal. And what we mean by capacity is essentially based on their income, they can't afford to take on a new facility because they're over leveraged. Collateral, this is really the assets owned by a borrower that can be used to secure a loan. In the previous section, we spoke about the different type of collateral for secured credit, and there was some good feedback on that, so everybody understands that. We don't need to go through that too much. But if you don't, just send me a question after. All right, so a credit risk example. So ignoring credit risk was the major factor behind the financial crisis of 2007 to 2008. In the years leading up to the crisis, banks and other lenders lent a lot of money in the form of subprime mortgages to high-risk borrowers. As the economy slowed down in 2006 to 2007, many of these risky borrowers could not afford to repay their loans, and the turbulence from the system failure to properly account for credit risk nearly wrecked the global financial system. And so this was really impacted, and a lot of those loans were not good loans. And so even to this day, that continues to be a case synopsis that people look at. So credit risk is very, very important. I had mentioned earlier too, in one of the examples we were looking through, um, one of the fundamental responsibilities of a bank, they have a fiduciary responsibility. Right? So you let's say if you have a deposit account at an institution and you deposit your money there, do you think your funds are just sitting there on the account, or do you think those funds are being utilized to grant credit to borrowers?
They would use the grant and credit.
Absolutely. So because it's your money, you want to make sure that the bank is actually executing sound lending guidelines in their process of advancing credit. So they can't be irresponsible in giving credit out. They need to make sure that a holistic credit risk assessment is done to say that this client can qualify. Now, I want to stick a pin here because in all cases, banks don't even have to do applications for credit. Some of you may be aware that banks actually do pre-approve offers now, right? Where the client doesn't have to complete a standard credit application. The client can get a pre-approved offer from a bank, and in some cases, those funds are on the client's account in less than 24 hours. Anybody familiar with that?
No.
Okay. Yeah, so it does happen.
That is the
Hmm?
Which bank does this?
Scotia. And how can you qualify for them?
So,
So I wouldn't tell you the good news and not tell you how, right?
oh,
So credit history is a very big one. So, they would look at the data on the client. It isn't done for typically new clients. So the bank would look at the data that they have, and based on that data, they would determine the overall credit risk of the client. And the client may have had facilities before that they repaid very well. And so based on that assessment, the bank would give pre-approved limits to those clients.
Institutions actually reach out to these clients without these clients even coming to them.
okay.
Yeah, so like it's digital. So like you could get let's say if you go to the ATM, something may pop up and say, "Hey, Damien, you qualify for $5,000. Do you want it?" You just hit yes, and then you have the money in your account.
Oh, wow.
Yeah. So the credit risk assessment is, thank goodness for technology. So you don't even have to rely solely on humans to do that. It's now the system automation even helps to make that even more easier.
And this one just in the US is involved?
Yeah.
Okay.
Yeah. That's done
Good
now.
stuff. Good stuff.
But how does the system, you said the credit risk assessment is done by a system. How,
Mm-hmm.
what system do they use?
So I mean it would so every bank will have different um different information management systems. Their technology could vary, but whenever a client enters your database and they get any facility, you could see how they repay. The data is there, right? So the technology is really advanced to be able to look at all of this data that we have collected on the client, and based on that, it would recommend a pre-approved limit for the client. So that's just how technology has evolved big time.
Okay.
Yeah.
Which bank does this?
Sorry, say that again.
You know which bank does it?
Scotiabank does it. I'm not sure about First Caribbean. I think they do too.
Okay. All right.
Yeah. Yeah. And then remember now, these are global financial institutions as well.
Okay.
Yeah. So it just takes us back to the point of, credit history is very important. Very, very important. So credit activity is always one of the core activities of a bank. So for banks and financial institutions, corporate customers are always the main subjects that they aim to grant credit. The amount of credit granted to corporate customers always accounts for the largest proportion and is also the riskiest. This is not only an activity that generates a major source of revenue for banks, but is also a potentially risky activity. We don't have to delve into that too much, but I just want to explain to you why it would be the largest proportion. Because usually when those commercial or corporate customers borrow, their ticket prices will be much larger, like very large ticket size transactions in the millions, compared to like on the consumer lending or the retail banking side, where the balance requested would be much lower. Okay. All right. So we actually moving a bit fast today. So I want us to kind of go through before we go on. I want us to go through what is credit. So I spoke about it a bit earlier. Anybody could quickly tell me what is credit? If you had to define it.
Credit is when you simple way you said was when you get something now to pay later.
Yeah. Yeah, so you got it. Hey, you have the context of it. So let me
Mhm.
give you all this rule with my course. You don't never have to do verbatim from the book. My objective is to make sure if you could explain it to somebody, it makes sense. And I will make sure that you understand, right? So the book is used as a guide, but through our discussions, and then of course through your own personal review, I just want for when you respond, whether you do it verbally or whether you do it on your exam, I just need to know that you have a good understanding of
Mhm.
it. Okay? So
Understood.
with that in mind, everybody should pass this course. Every single person. Because I have not had nobody not pass a course for 1 and 2. All right. Okay, so that is that. We didn't go through the 5 C's of credit, but I alluded to all of them when I was speaking. Anybody could tell me, give me the first one. What are the 5 C's of credit?
Character,
Yes, and what is character?
the type of person you are, whether you're a person of your word or not.
Mm-hmm. And what determines character? Hmm.
When you
If you're
say
able,
what you're gonna pay, then you actually pay the debt.
Mm-hmm. So credit history, right? Yep. So
Yeah.
credit history. So you're right. Thank you. All right, next one. Let me give it to you. Capacity. Who want to explain that for me?
Capacity.
Mm-hmm. Who that is? Karen? What it is? Capacity. Okay. Explain capacity for me, please, Mariah.
Uh, you catch me off guard.
Oh, I saw your phone unmuted. Sorry. Okay. No, I don't want to do that to you. Anybody else want to do it? All right. So
I
capacity
could
just
try. Oh, sorry.
go ahead,
Basically,
Michelle.
when they want to see if you have the ability to pay the loan.
Yes, the ability to repay the facility back. Yes. And what ratio do we look at to determine if you have the capacity?
That's
Debt
it.
service?
Yeah. Y'all got it. Y'all got it. We could have midterm soon. Yeah, y'all got it. Okay, so capacity, we look at the total debt service ratio. You may hear it called DSR. You may hear it called TDSR. So don't get confused. It's all the same thing. All right. So we have character, we have capacity. Anything else?
Collateral.
Yes. And what's collateral?
So collateral is basically when something is being held until that facility or that loan is paid off. For example, a mortgage can be held as collateral, or automobile can be held as collateral, or something can be cash secured to be held as collateral.
Yes, you got it. Thank you. Very good. So collateral is considered secured or unsecured credit.
Secured.
Secured. Yes. All right. Thank you. So character, capacity, collateral. I know I didn't go through these with you, but take a guess. Anybody want to take a guess on what the next one is?
Conditions.
Yes, conditions. What would that be?
That's the terms used for getting a loan.
Yeah, so that could vary, but basically it's the conditions of the facility, right? So for example, you may have a facility where um let's say the client could get a salary deduction and you add it as a condition just to make sure you tighten up the credit proposal a bit more. And that's only an example, but what are the conditions that you're placing on the proposal to further strengthen it? So yeah, that's one you can look at. Any others? Character, capacity, collateral, conditions. We missing one.
Capital.
Yes. And what is capital?
I would say how much the person earns annually, or like how much they get paid in order to facilitate the loan.
No.
Their financial strength.
Yeah, so financial strength.
Okay.
Yeah, but capital would be, so what do they bring to the table in terms of assets, right? So like let's think of a business, right? When you think
Yes,
of
ma'am.
a business and you think about capital, what do you think about?
Would you start your business up with?
Yeah. So how much you
Funds.
bring into the table?
Yeah.
Yeah. Yeah. So sometimes it may be a bit challenging to to truly understand the definition of capital when it comes to like individuals, but it's the same thing. So, for example, when you go to a financial institution to apply for anything, they would normally ask you, or they should, like, what are your assets and what are your liabilities? So if you're a client who's coming in with a bunch of liabilities and no assets, and let's say you've been working for 10 years, making a good income, like what's the type of questions you as a banker would ask?
What are you doing with your money?
Yeah, in the professional way.
Do you have savings elsewhere?
I like that one. Yeah, so tell me a bit more. Because sometimes clients, they say they don't want to tell you everything. Because then you would start asking for this and start asking for that, right? So even though that's the question, we know it's deep within our heart, like what you've been doing with your money, we have to find a way like to position it properly, just so, they don't feel a certain type of way.
Probably
And another
question what kind of assets they have it. Oh, sorry.
Yeah, yeah, what kind of assets? But then too, when you're dealing with clients, don't get too caught up with these terminologies because some people don't understand what assets is.
Yeah.
Yeah.
You can ask them if they have any loan elsewhere.
Yeah. So like if they have any loans, because you're not seeing like the corresponding asset, right?
Mhm.
Also, too, something that I find to
Mm.
be very helpful is ask them, did you have any life event occur? Right? And when I say life event, sometimes people go through divorces, sickness, helping ailing parents, you know, children, and that takes a lien on their cash assets, etc. And so sometimes just by knowing that story, can help you to get a better appreciation of why their picture looks the way it looks. Okay. All right. So good stuff there. So capital is very, very important to an application. Sometimes you may find that they don't need to have much capital for auto loans or sometimes even unsecured facilities. But in the instance of a mortgage, what do they definitely need to make sure they have access to? In terms of the capital, what do we call that?
Insurance. Oh, the capital.
Mm-hmm.
What you mean, the papers?
Maybe
The
like
down,
Mortgage?
land papers.
The
no,
land paper?
the down payment.
Payment. Yeah.
Yeah,
Oh,
that's
okay.
it. Yeah.
Yeah. So that would essentially be their capital. Hmm? All right. That would essentially be their capital, the down payment. Yeah. All right. Um, so that will essentially be their down payment. It's important to make sure that they have access to that. All right. So even on the application, you would reflect that as an asset, so that the bank is clearly able to see that the client has the ability, to move forward with that type of product. And mortgages require a down payment ranging from like 5 to 15%. It depends on the institution though. All right. So that's the five C's right there. They will come up again. So just make sure you're familiar with it and you're able to really explain what it is because you're gonna see it twice. You could figure out where that will be. All right. Okay, so any questions so far?
So far, so good.
So far, so good. All right. All right, so good stuff. So we actually moving a bit fast. So I want us to do a group discussion now. It's 7:34. Typically, this will end around 8 o'clock. So as a part of it, I want for you to talk to me in terms of let's talk a little bit about delinquency, right? What would typically cause accounts to go delinquent?
Late
What does
When
that
the
mean?
payments.
customer isn't paying.
Payments.
So customer isn't paying. So we call that willful neglect.
Payments that are short.
Payments that are short.
Mhm.
Yeah, they put something on it, but not all.
Yeah.
That's
All
what's
right.
required.
Yeah, as required. Payments that are short. So, okay. What else? Any others?
Someone sent a message in the chat.
Oh, I share my screen so I can't see. What does it say?
No activity.
Oh,
Activity
no
on account.
activity. So passed away then. Yeah. So what will cause accounts to go delinquent?
Uh, Death.
Yeah, so death. Mm-hmm.
Off the job.
Job loss.
Losing
Yeah.
your job.
Good.
Yeah.
Unemployment.
So job loss,
Injury,
unemployment. What else?
Incarceration.
injury or hospitalized.
Yeah.
Incarceration.
Yes, yes,
Definitely that.
incarceration.
Yeah, that's true.
Good
That's
one, buddy.
true.
Leaving the
That's
island.
true.
Yeah,
Go
incarceration,
in Canada.
Yes, relocation.
Yeah,
Relocate. Yeah.
relocation.
Hey, New Year's resolution. They ain't taking on nothing. Eh, Yeah, they ain't taking on nothing. All right. So, I saw this joke, funny joke. Someone posted something. They was like, my bank called me the other day and told me my account, what? Say something was outstanding, right? And so, like, they meant when they heard the word outstanding, they was thinking that was exceptional, when really it wasn't. They was meaning like the payment was outstanding. I was like, wow, wow. Perspective, eh? Perspective. So, financial literacy important. Yeah. So, okay, so I did that just now because I wanted to just kind of talk through, like, there could be a lot of different reasons why accounts go delinquent, right? And so through the delinquency process, one of the first things is you want to make sure you understand what caused the root of delinquency. So typically when a collections officer would reach out to a client, it shouldn't just be to ask, you know, when
If you're
you're
going
gonna
to pay this
pay.
money.
Yeah, like what happened, right? Because sometimes the issues could be resolved right away. And I say that based on these scenarios that I've seen before. So, for example, if you see government facilities go delinquent, you know something wrong, right? Because typically they would be secured by salary deductions. And so, in instances like that, it could just be a case where the salary deduction date isn't aligned with the payment due date. And so, to make it right for the client, internally, the bank is able to just do some back end adjustment to make sure that they align everything up, which will greatly help the client's credit history, but also the client's experience with them. Because you don't want to tell a person who have a salary deduction their facility's been late XYZ just because of a simple payment not being aligned. So it's important that when you start the collection calls to understand what is the root cause of the delinquency to determine if it's something that could be addressed internally or, if you have to look at some other solution or maybe there's no solution at all. It's a simply you need to pay. And when are you going to be able to pay it? So it's important that collection officers are properly trained to be able to have those conversations with clients. And one thing I've learned is it can differ for all clients are different. But a general rule to start from is, have empathy. And when I say have empathy is even in terms of reaching out to the clients, like people tend to work with people who are working with them, right? So you will find that even in the soft delinquency stage, it's easy to really capture a lot of them from moving forward once you quickly call the client and you understand what is happening to see, what solution you could probably come to. All right. So we understand that there could be a lot of reasons why accounts go into collections, and I'm making notes whilst you give me this feedback. So, why is it important for us to ensure that just as much focus as we have on the front end with collections, why do we need to ensure that we have that focus in the back too when it comes to collections? So, just so we focus on in the front when we grant in the facility, why we have to do the same thing in the back?
Can you repeat that?
So why should we have that same level of focus in collections, similar to what we have even when we're granting loans? So in other words, why is it equally important to collect our money, just how important it is to put the loans on the books?
Because you have to get a salary too.
Yeah, well, that's one. That's a very important one.
You want to maintain the relationship with the client so that
Mm-hmm.
they don't try to go to another
Yeah.
bank.
Yeah, so think of yourself as the person who owned the bank. So let's go up couple levels,
Want to
right?
get
And
the
it was
money
their bank.
back.
Yeah,
Yeah.
you want the
You want
bank
to
to
make sure you have
the
a good client
income.
and banking relationship.
To
Mm-hmm.
prevent the
You-
company from going bankrupt.
Absolutely.
absolutely.
Yeah.
That's like the main thing.
Yes, yeah. So absolutely. So the people ain't pay the money back. That's money which you take from somewhere to give them.
Hmm.
So you need to make sure that you collecting your funds, right? So collections, they would normally have like a certain threshold that they have to remain under in terms of the total amount of their lending portfolio, which is delinquent, and that threshold could vary from bank to bank, but I think there's a central bank standard. I can't remember. So they would use it as a metric to determine how well they are doing with collections and managing delinquent portfolios. And they also use that data to see if they need to make changes to credit policies. So when they look at, let's say if they notice a significant hike in delinquency in a certain period, they could drill down to see, well, is this coming from a specific branch, a specific officer? Is there something going on in this industry? Like what's happening? So they could use that data to drill a bit deeper to see if it's just one-off or if it may be related to a process breakdown, unique to a certain branch, etc. And they could kind of take steps to see what they'd want to do next. And I say that because you may have instances where the origination process may have opportunities. And when I say origination, let's say if you see 4 facilities go delinquent from one particular officer, and when you go and you review the file, you notice where there's some areas of opportunity. Maybe we could have asked for a deduction. Maybe there wasn't a certain level of due diligence that was performed. And so it gives you an opportunity as the institution to be able to provide coaching to that officer if possible, or whatever solution you could come up to. But I just use that as an example to say sometimes it could be unique to certain scenarios. And so it's important to understand what created the delinquency so you could go ahead and recommend the next best solution to resolve it. All right. So let's kind of look at credit policy, and we will end on this. And I want you to start reading over it for next session. So every organization has their own credit policies and it could be different. So for example, competitors, they in the same industry, banks, you'll find that some things they do similarly, some things are very different. And that's all about having a competitive advantage. Because if everybody doing it the same way, you're not really unique from your competitor, right? So while most companies have their own policies and procedures, it is unlikely that any two firms will define them in a similar manner. So what that essentially means is, some of the aspects of your policy could be different between Bank A and Bank B. So furthermore, while many individuals appreciate the need for a workable set of regulations, policy carries some negative connotations of bureaucracy and inflexibility. The word is derived from the same root as politics and police, and the sentence, "It's not our policy," can infuriate customers. So I'm sure you may have heard that before. So in lending institutions or even outside, any institution that deals with advancing credit, people just don't wake up in the morning and come up with rules. They are guided by a credit policy. And even though it is a credit policy, think of it as a box that you have to work within, but there are instances where you can seek exceptions. And when I say seek exceptions to the policy, you may have a client that one of the criteria they don't necessarily meet, but when you look at the proposal, the client is really a good client. And so you can make a case on exception to whoever approves your credit decisions to say, well, I want for us to take a look at, and I'm just saying this sentence, but you want to present this credit proposal. And of course, in your credit proposal, you will indicate what's your justification or your rationale in terms of why you want to make an exception for the client. Always remember, whenever you're making exceptions, if you are allowed to do so, if you are allowed to submit proposals on exception, always remember, always speak to the 5 C's, because that is really the fundamental of credit. So when I say speak to that, like first you could point out what the exception is. So your exception, for example, may be capacity, right? Let's say your bank says our limit is 40% and the client can't go over 40%. But in this case, the client's total debt service ratio may go up to 42% when you add up everything. It's no way you could get it down to 40, but you notice a good client because every other C, the client checks off. You can make a proposal to consider the 42% because it's only two things they could tell you yes or no, right? And some things that can help you with that is really highlighting the strength of the client. You could also speak to what the client's remaining disposable income is. And let's delve a bit deep into that so you could have a better appreciation of what I mean. Let's say you have a client who is making $75,000 a year. And out of that $75,000, 75,000 divided by 12, out of that 75,000, that means we working with $6,250 every month. So because you've said that their total debt service ratio is 42%, essentially you're saying that out of the $6,250, $2,625 a month is going towards debt. Because remember now your ratio is up to 42%, and the bank saying they only could do 40%. So you're saying that 2,625 is going towards debt. Mariah, you have a question?
No, I got a call.
Oh, okay.
Sorry.
Okay. So because we know 2,625 is going towards debt, that means that the client only has about 3,625 left, right? Do you think that that is sufficient remaining disposable income for the client each month to be able to meet unforeseen and foreseen expenses?
Yeah, I mean, well, you have to consider they have a family.
Yeah, I don't think so. They have
But yeah, I mean, and I think that's sufficient if they. I mean, well, it depends on the family if the other person works as well and how much kids they got and stuff like that. But yeah,
What did you
Yeah,
say? At 40%, you said? At 42%, you said?
yeah, they had 42, but the bank's policy is 40.
Oh, okay.
But I like your response because you're really thinking about it. So, for example, you all talked about family. Now, you might say 3625 only me, I could work with that, right? But if you have an application where, because usually your application asks you of any dependents, don't think they're just asking it to know how busy you've been. That ain't it. They're never asking you, they asking you because they want to know how many people do you support, right?
yes.
And what is another thing that they ask you? Married or
If it's
not, right?
single or married, yeah.
Okay. So even though, sorry, I have like some ambulance driving past. So even though even though that's a question on the application, don't take that for granted because by knowing that particular information, that could help you greatly with your exception, right? So the client could have a balance of 3625 remaining, but the client only have one child and they married. But you haven't even factored in the husband's income, right? Yeah. So you more than likely you have a good case to proceed with an exception. It may also be an instance where the client works for an organization where they could get salary deduction, right? So by putting the salary deduction in place, it just further solidifies the rationale that the client will repay. All right. So just wanted you to, policies are policies. You have to know your policies. You have to know your credit policies. And when you know your credit policies, so we call them adjudicators. Some people may call them, I don't know. So adjudicators, persons who approve the applications. They may have different title names, but an adjudicator always knows someone who knows their policies. And so when you know your policy, you stand a better ground in terms of knowing when you have a good case to fight for an exception, right? So always make sure you have a full understanding of your policy, but use it as a guide. Don't let it stifle you in terms of what you could do, what you can do. Just know it so that if you have a proposal that you think is worth fighting for, submitting on exception, then you're a bit more confident to do that because you know you're addressing whatever the issue is. All right. Any questions? So why are credit policies important? So first, the responsibility of managing receivables is a serious undertaking. It involves limiting bad debts and improving cash flow. So with outstanding receivables often being a firm's major asset, it is obvious that a reasoned and structured approach to credit management is necessary. So you need a credit policy to ensure that you're practicing firm credit underwriting, you're advancing credit to persons who are able to repay the facility back. And of course, you're pricing them at a rate where you can get a return and be able to run a sustainable business. So secondly, a policy also assures a degree of consistency among departments. All that simply means is people ain't waking up with their own rules on if they're giving you the loan or not. There's a document that they can refer to that they can use as a guide in terms of helping them to analyze if the credit proposal can be presented or not. Thirdly, it also provides for a consistent approach among clients. So decision making becomes a logical function based on predetermined parameters. This simplifies the decision process and yields a sense of fairness that would also improve customer relations. All that means is if a client call you and say, Jasmine, how much y'all need for a down payment? You should be able to answer, right? How much y'all need for a down payment for a home? You should be able to answer that. I'm talking to this other bank and they telling me I have to put down 20%. How much do you offer? What's your down payment? You don't need to say to the client, oh, I could see and let you know. You should be able to confidently speak to the client and say, this is what our policy says, etc. And through communicating that to the client, it ensures that it helps you with customer loyalty as well, because they know they're dealing with a bank who's very structured. They have a sound credit risk policy in place, and they may even be depositors in your institution as well. So they know you're lending out their money based on sound underwriting rules. And so it just ties hand in hand. And then last, it can also provide some recognition of the credit department as a separate entity, one which is worthy of providing input into the overall strategy of the firm. So what this means is you'll find that the persons who provide expertise or guidance on the credit risk policies, they're usually not a part of the branch. So it's a whole separate unit. And so their responsibilities and function, they work together with the overall organization, but they're not the ones who are actually advancing the credit. And so what that does is it mitigates risk because you have different roles with different responsibilities. The credit department who's underwriting the policies, they're focused on making sure that they have tight credit risk policies in place. Not just tight, remember now, you also have to be flexible with advancing credit. So their job is really, really important. So they work along with those who are advancing credit to ensure that they're able to assist clients with whatever it is that they need. All right. Any questions so far? Okay. So one can see that developing a policy is more than a necessity. It is an opportunity to improve the efficiency of the overall organization. So credit policies can differ in both length and content. So what this essentially means here is you could have a 100-page policy and somebody else could have an 80-page policy. Institutions may also have policies in different, let's say you could find a policy on mortgages, credit cards in this particular section, and for other products such as credit cards or loans, they may be in different sections. So it isn't always combined in one. They may have it in different places, but it will be easily accessible for those who are involved with the credit lending process. All right. So there's a section here that talks about developing your credit policy, and it's just giving you some tips on if you were to ever write a credit policy. So what this means is, let's say in the future you get a job or a role dealing with credit risk. From time to time, you may be asked to help with the policy writing. And there's a few questions that you or your company could look to answer during the process of writing that policy. So some of those questions to consider is, what is the mission? What is the goals? Who has specific credit responsibilities? How is the credit evaluated? How is collections handled? And what are the terms of sale? All right. You don't really have to worry about that particular section too much. It's just a good to know if it is that you go into a role that would require you participate in a credit policy review or implementation. So it's 7:57. We'll wrap up at 8, but I want to use the last 3 minutes just to ask if there's any questions. And I know we had some persons who would have joined a little bit after. So just for the benefit of you, the midterm, I'm going to send an email with the dates, all right, on the midterm exam and the final exam, just so everyone has it.
Okay, and the book which you're reading from?
You guys don't have the book?
I picked mine up yesterday.
Okay. Reach out to
so-
Miss
say
Dean.
it again?
Reach out to Miss Dean for the book.
Okay.
Okay. All right. Let me, while I'm on this, so after I will put, let me actually put it in the chat now. So in the chat, well, you have it, but I can put it here. So in the chat, I'm going to give you my email address. And I want to make sure that you pass this class. I'm also going to give you my contact number on one condition. Don't ever share it. That's the only condition.
Fair enough.
Okay. All right. Any questions though?
No, I think that's about it. Very straightforward.
Okay.
Let me stop speaking for everybody. Everyone good? I guess so.
Yeah.
Yeah,
I'm good.
Wonderful.
I'm good.
So thank you for who is co-hosting with me. That's Damien or Bruce?
Yes,
Yeah.
ma'am. Sorry.
Okay. Well, thank you for being my co-host. I love it. I must say that I love the participation of all of you in the class tonight. Very good. So y'all sound like y'all getting your 10% automatic. The only ask I have of you is to make sure that after the session, you just go through it before we come back to the next class. So if you have any questions, you could just let me know. And then sometimes I will go back just to kind of test to make sure everyone's good. All right.
Thank you.
Okay, so I put it and then I'll send the email with the information. Let me just quickly put something in here before we end the call. So remember the participation is 10%. Participation is 10%. So freshman, so midterm 30. And final 60. Okay. So that's the waiting for how we get to your grade.
Excuse me. Sorry.
Okay.
Okay.
All right. Okay, so that's it from me. Thank you, everyone, and I wish you all a wonderful next couple days for the rest of this week, and God's willing, I'll see you guys next week.
All right, you too.
Thank you.
Thank
Thank
you.
Good
Thank
evening.
you. Good night.